Good morning. It's the 6th of August, and this is Govindraj Ethiraj, headquartered in broadcasting and streaming from Mumbai, India's financial capital. The take. There is one thing that somewhat links the stock market crash that we will talk about, the massive unrest in Bangladesh leading to the unseating of Prime Minister Sheikh Hasina and even riots in England. It's jobs and youth, or restless youth, perhaps in that order. So let's recap from Friday last week when job growth in the United States slowed more than expected and the unemployment rate went up to 4.3%, the highest since 2021. In Bangladesh, protests erupted last month after a High Court ruling in June reinstated a 30% quota in government jobs for family members of freedom fighters of a 1971 Bangladeshi liberation war. The move was seen as discriminatory by thousands of students. And riots in England in the last week. Violence on the streets as youths protest against immigrants. Now, the reasons for this may not be only jobs, but it has a role. In many countries, immigration is leading to job insecurity for locals. 2 years ago, students stormed and occupied the president's house in Colombo, in Sri Lanka, in a move similar to the storming of Sheikh Hasina's home in Dhaka yesterday. Sri Lankan students were protesting mismanagement of the economy, among other things. In India, the government is now effectively throwing the kitchen sink when it comes to jobs, from incentives for manufacturing to incentives for hiring to nudges for internships and much more. But on the other hand, a state like Karnataka tried to reserve both blue and white-collar jobs for locals, a move that backfired and had to be shelved, but only for now. Youth unemployment is high world over, including in India. I hesitate to quote figures because figures are contested and debates tend to focus on the accuracy of the figures than what they represent. And meanwhile, frustrations are rising. The manifestations of this frustration will vary from country to country, from voting in ballot boxes to outright violence as in Bangladesh or Sri Lanka. So there is no silver bullet for solving jobs challenges in this complex economy. We can't be a China, but we can't be a not China either. And to be sure, we're trying all approaches, or both approaches, including that of heavy public spending-led employment generation. But our needs are greater. The solution often lies in looking at the problem bottom-up and working on the plumbing of policy to ensure businesses feel encouraged and motivated to set up or expand their capacities. And when I say businesses, I mean even small entrepreneurs. While industry can rightfully focus on being lean and mean, it cannot run from the larger problem of disaffected youth or socio-economic stress. And that perhaps is the moral of the story. If the solution does not belong to everyone, then the problem will belong to everyone. And that brings us to the top stories and themes. The markets cracked 2,300 points and could fall further. Japan sees the highest fall in its stock markets in 50 years. Oil prices slide and so does gold. Will Indian markets follow global cues all the way down or delink? And finally, Indigo launches its business class.
This is the Core Report with Govindraj Ethiraj.
The markets on edge. The good news, if you wanted, at least for Monday's trade, is that Indian markets fell less than their Asian counterparts, which brings us to a slightly larger and important question on how insulated are Indian markets from global ones at this point, given the counterbalancing effect of domestic flows. We will touch upon that shortly in a longish conversation that follows with Deepak Shenoy and Abid Hassan. The BSE Sensex and the NSE Nifty fell sharply on Monday to end in the red, in keeping with losses amongst global peers. The Sensex was down about 2.8% or 2,225 points to close at 78,768. The index was actually down almost 3% during the day. The Nifty 50 was down 662 points to close at 24,055. The fear index, or India VIX, ended at 20.3 points, which is up about 42%, suggesting massive volatility in the markets. The volatility index itself zoomed 61% intraday, marking its largest increase since 2015. So why is all of this happening? Well, globally, there is a rapid unloading of carry trades that started Friday, which is the unloading, and extended into Monday, with market participants trying to roll back on this strategy amidst a global sell-off in risk assets. So what are carry trades? Well, quite simply, carry trades are those where an investor borrows in a currency with low interest rates, such as the Japanese yen, and reinvests the proceeds in higher-yielding assets anywhere else. Now, those other assets could also include Indian equities. Now, this strategy has apparently been quite popular, but the moment the yen became stronger, as it has right now, global investors are unwinding their positions and getting out of the yen, which funded their investments. So the big news on Monday was the dramatic fall in Japanese stocks, with the Nikkei 25 and Topix dropping over 12%. And these benchmark indices have fallen more than 20% from their all-time highs just as recently as July 11th, says CNBC. The 12% loss on the Nikkei, which saw it close at 31,458, was the worst day for the index since the Black Monday of 1987. The Nikkei has also erased all of its gains so far this year and moving into a loss position. On Wall Street, meanwhile, the Nasdaq and Dow Jones opened close to 5% down on Monday morning and were tracking a fall in futures as well. Treasury yields dropped again on Monday as investors moved to traditionally safer assets amidst this global stock market sell-off on the concern that a US recession could take hold in near future, according to CNBC. So what is clear from all these events is that the Indian market is not as resilient or resistant to global cues despite all the consistent domestic inflows that we speak of quite frequently. Also remember that Indian markets have a somewhat unpredictable layer in the form of a large catchment of derivatives trade and traders. More on that shortly. Oil and gold both fall. Gold or spot bullion fell about 3.2%, the biggest single-day drop since early June. Other precious metals have also fallen sharply, with silver down by as much as 7.2%, according to Bloomberg. All of this should be somewhat good news for Indian buyers who are also digesting a reduction in import duties effected in the union budget last month. Elsewhere, oil prices continue to hold against heightened geopolitical tensions by falling to a fresh 7-month low. Brent futures were quoting below $76 a barrel, and that happens to be the lowest since January. And remember, the fall in global equities, particularly the United States, is triggered by concerns around a weak economy, according to Bloomberg. Some telecom news and a break from markets. Bharti Airtel's net profit for the April to May quarter, that's of Q1 of 2025, rose about 158% to 4,159 crores. Profits more than doubled from 2,071 crores in the preceding quarter. Bharti said that the profits or the rise in profits was because of a greater focus on cost efficiencies, rising number of 4G and 5G users, and continued growth in business categories such as homes. Bharti said revenues of its group subsidiaries continue to be hit by devaluation of African currencies, particularly the Nigerian naira. Which way are markets headed? So even before yesterday's fall, there has been considerable discussion around valuation, rather the overvaluations in the market. Now, the core report has been speaking about the lack of sufficient concern for valuations, or rather high valuations in Indian markets, in contrast to, let's say, the Wall Street, where investors have been questioning, among other things, the companies leading the AI or the artificial intelligence boom, and whether all of that hype was likely to translate into some reality. Back here, the markets are, of course, seeing unprecedented levels of participation, including by youngsters borrowing to play in the derivatives market and then losing some. The regulatory bodies in response, including Sebi, are tightening the screws on derivatives trading slowly and steadily, and many steps are still to come. But the question is, how will the markets hold up at times like this, where minor triggers could lead to major falls? And how should investors and traders be viewing moments like this one? To discuss this, I'm joined by Deepak Shenoy, founder of Capitalmind, a SEBI-registered portfolio manager, and Abid Hassan, CEO of Sensibull, a large options trading platform, both based out of Bangalore. I began by asking Deepak about the current market conditions and the volatility implicit in the moves and what was causing it before coming to the outlook for the markets with both Deepak and Abid. So, Deepak, let me start with you. I mean, we've basically hit a fresh bump, which is global. What in your mind is causing or triggering it in the Indian context, and what is at stake for us?
So, to be honest, Govind, I think there is a problem in the fact that we think this is volatility. This is not really volatility. We have been numbed by years of free money sloshing around in the markets to believe that a 2.8% day is volatility. I'm happy for that, and I'll come to the second point. Derivatives has caused us to believe this way because they have numbed the volatility in the market by just their sheer existence. But apart from that, beyond this, where are we? We can't take explanations like I don't know, because no longer is that acceptable. So therefore, I will have to make up stuff on the fly. But to be fair, there are lots of worries. Okay, there's an Iran and something war going on. There is a problem with Japan, because the Japanese market has fallen some 25% in the last 2 days, and everybody's worried that it will fall another 25%. Meaningfully so, because Japanese markets have kind of had regained their high that they had in 1992 now, just a few days ago, and now they've lost that vantage point again. And of course, you have the other issues of, oh, there's going to be a recession in the US, there's going to be interest rates, employment is coming down, Buffett has sold his Apple shares. This is the kind of stuff that's happening. But let me put this backdrop in very clearly that, markets have been running up. They're not supposed to only be going up, supposed to go up and down. And the longer the markets go up without going down, you have potentially this point at which markets will correct a little bit stronger and harder than you are, and they usually need an excuse to do so. Today, we're getting that excuse in the form of X. 2 years ago, we got that excuse in the form of Ukraine and the war with Russia. 1 year ago, we got Silicon Valley Bank. Then we got something else. So every few months, we get some new excuse. Sometimes those excuses work in bringing down the market, substantially. Many times they just don't. Today, I think, is one of those times when you've got the news, you've got a reaction that Japanese markets are down. This is potentially causing a worldwide liquidity crisis. It's not actually, because the data doesn't seem to indicate a worldwide liquidity crisis yet. Because although people are afraid that Japanese interest rates have gone up, they are so far away from US interest rates that if there is a carry trade, that carry trade continues to thrive because of the difference in rates between the two countries. However, asset prices have, and because of exchange rates 2 years ago of the yen versus the dollar were about 110 yen to the US dollar. They became 160. Imagine losing 50% of your currency in 2 years. India would freak out like crazy, but Japan didn't, because this was probably fueling the carry trade, as you may. Because as the currency depreciates, it makes sense to borrow in yen and deploy in anywhere else. And then the yen depreciates, it's good for you. You even cause the depreciation of yen. It is on the other side, there's a problem when the yen starts to appreciate. You suddenly realize that you have to pay back in yen. You've just lost. If you borrowed in yen recently, you kind of have to pay a higher amount. And that's what's causing this consternation. But I don't think this is meaningful in terms of size to bring down world markets down by so much. It's just an excuse, like I said, an excuse that the world has kind of used to kind of bring asset prices which are going down. So we are part of that story.
Okay. So I'm going to come back to you on a couple of more fundamental questions. But Abid, let me pick up with the statement that Deepak made about derivatives numbing the market in a way. How would you see it?
I'm not sure if numbing is the word I'd use, because the issue with derivatives, right, is that people end up doing things which they can't afford to pay out of their pocket, because basically it's leverage, right? So, see, I personally have been in an institution which had a $300 million margin call overnight because they gambled with money which they did not have, right? And people had to bail them out. Now, if you ask me, like Deepak said, right, I personally agree with Deepak in the sense that I don't think Japan has anything to do with it, right? This is just something else which has been developing for years and years, because, see, nobody ever asked what is the joy because of which market is going up so much. I mean, everybody knew what is the joy. The joy, of course, was free money was getting printed in Japan, US, everywhere. So basically, if you are getting free money and this is a musical chair going on and you don't exactly know when is the music stopping, people will keep on passing the chair or hat or whatever it is, right? But they did that using a lot of leverage, and that leverage was provided by derivatives, right? Whether it is long-term swaps or whether it is just options or futures or whatever it is. So the fundamental disease which Deepak highlighted could be much better exploited by people by using derivatives. But the reverse of the argument is that when even the slightest sign that something could go wrong, even the smallest of the flash in the pan happens, the people who get scared the most, the people who chicken out first, are people who have leveraged. And invariably, they are the people who did whatever they are doing through a derivative, right? So in a all cash world was where nobody was doing nothing through leverage and it was purely cash, the Japanese yen carry trade would have probably been a 0.5% event today. But because there are so many people who are running long-term interest rate swaps on, so I'll give you a fun fact, right? I used to trade interest rate swaps in 2011. At that point of time, interest rate swaps were 60 times the world GDP. I don't want to guess how many times it is now. Basically, interest rate swaps are the ones which extremely large institutions use to gamble between currencies, right? So I think The leverage to cause such a mega movement in rates and currencies was provided because of these kind of derivatives. And the sudden movements are happening because somebody is chickening out of a very large derivative trade which they could not afford in cash in the first place.
Got it. Okay, Deepak, let's come back to the Indian markets. Now, a very fundamental question. Are we insulated or are we not insulated? Because what we saw on Monday, for example, suggests that we are not insulated because we seem to have almost moved, though in a smaller margin, in tandem with Asian markets and overnight or over the weekend, US markets and so on.
So in a risk dominated world, when you get risk, all asset correlations go to one. Okay, that's the thing. Essentially, at a point when everything looks bad, everything is going to drop without any regard for the fact that, oh, India is insulated in terms of, oh, we are a domestic economy, etc., etc., etc.
And we've got flows coming in every month and so on.
I mean, let's assume that that's also at risk to a certain extent. We saw flows going out for 1.5 years between 22 and 23, and the market continued to stay strong. In fact, went up because domestic inflows continued. Right? Foreign inflows became foreign outflows. Even this year so far, foreign investors have only been net investors into the market. Today, with the dollar declining just, I think, 0.1 or 0.01% or something like that.
We're at a record low.
Yeah, as it's not been meaningful as a drop in terms of the.
Yeah. I mean, it's very small, but it is a record low.
Yeah. So that also sounds unreasonable because other currencies have actually appreciated compared to the dollar, and India has actually kind of depreciated against the dollar, which could be a sign that our equity markets are seeing outflows. But even if that is an outflow, it's not a meaningful enough outflow for us to be worried about. So are we insulated in an extreme event? No. In possibly more normal times, I would expect that India would behave slightly differently from a Japan or a US or anything like that, primarily because we have the growth that other countries don't necessarily. We are not facing oncoming recessions, and we don't have the kind of leverage that the US markets seem to have. When I say that, I mean not just the market leverage, but I'm also talking about bank leverage. I'm talking about loans taken by individuals for, say, school, study loans, that is education loans or car loans, where the leverage is relatively at a higher rate in the US. We are not at the same extent. But having said that, when, there is an earthquake around the world, everything is going to tremor a little bit. And that includes India. Markets run in the short term on sentiment, in the long term on more fundamentals. But sentiment is going to carry through the normal everyday narrative, while the long term means long enough for people not to care. So nobody remembers Brexit today. When Brexit happened, we lost 6%. Why should Britain leaving? We were the original Brexit. India is Brexit, right? But we should be rejoicing that, Britain's leaving something else. But apparently our markets went down 6%. Then it took the world a few days to recognize that, oh, this is not the end of the world. And then, nobody even remembers that day. I can bet that you won't even remember the year.
As mega short Brexit, I thought nobody seeing this happening. I remember the date. I remember even the time at which I exited my shorts.
Sure.
So,
There you go. It's interesting because, I mean, other than Abid, nobody remembers the date. I don't remember the year in which it happened. I mean, roughly the 2014 to 2016 kind of time. Maybe 70, I don't know. But the sad part about commentary like this is that we are giving a lot of importance to an event that's happening now, when we know that the events that happened in the past have almost had very little impact on our long-term growth. But because narrative drives the short term, we have to sit back and analyze whether this is going to permanently, damage us.
Abid, again, if I were to come back to the derivative side of the market and looking at the domestic market now, so at times like this, where we are either plugged in or not plugged into what is happening globally, and that is, of course, as Deepak just spoke about, affecting our markets, what is the role that derivatives and derivative traders play or could play?
So I don't think the derivative markets in India, the retail investors at least. Okay, so I'll give you interesting facts, right? 13 out of 15 trades in India on derivatives are long call options. Okay, they are just buy call options. So I have a friend, for example, who have been in the markets for 15 years as a cash investor. When I told him, why don't you go buy a put? His response was, How can I buy a put? I don't have the asset. How can I sell something that I don't have? So he fundamentally did not understand that a person without an asset can actually buy a put, right? And it is revealing because this person went to the finest engineering college in Kerala, was a cash investor for 15 years, and yet he did not know that he could buy a naked put. And then we looked at the data. So Sensible's own data, right? See, we are a platform where slightly sophisticated janta come in, where normally 9 out of 10 people lose money. Maybe in us, only 7 out of 10 people lose money. It's a huge jump, right? I mean, I understand most people still lose money, but it's like 3 times better than the usual, right? Even in our system, 13 out of 15 trades are just by OTM call option. So essentially, the only retail play in India, the way at least I look at it, or we are seeing from data, is that people go and buy call option, right? Put options are not, people don't buy. And the other thing which we noticed is the entire prospect theory and disposition effect says that in case there is a small profit, retail investors cash out early. In case there's a big thing coming, they don't ride it. So even if I know a friend who is like long December 23,000 puts by the truckloads, I'm pretty sure the moment he is 10% up, he'll exit. Essentially, the only people who buy long dated puts and ride it out crazy are people like Michael Berry and Ackman and who not, right? So I think the only real addition that Indian average retail investor does in terms of derivatives in the market is that they just give shorting liquidity for institutional players. And unfortunately, I feel this is going to happen again. They are all going to get burned. And people are, so the last two, in 2008, derivative volume dropped by 70%. And mind you, 2008 was a time when India was not even as connected as it is right now, right? We were very, very insulated. We were entirely in cash, and yet we dipped 40 to 50% in Nifty, right? In 2008, when we were a cash only economy, when we had no rhyme or reason to do that. But now, see, indirectly, forget about people who are employed by American companies, right? 90% of our service revenue comes from US or Europe. If there is something seriously wrong in US, we have a direct economic hit now compared to a liquidity or a sell-off or a risk of trade coming in 2008. And that is going to be mega amplified because of the kind of leverage which is in India's system. And by the way, everybody talks about option leverage. There's one leverage which nobody talks about in India, which is an equally worrying thing for me. It is margin funded trading. One is official margin funded trading, where brokers are letting people leverage by margin funding. The second is, I don't think anybody has a clue how much money in India, which is right now in cash equity segment, is borrowed money, whether it is a personal loan or something else, pledge or something else. So I
I
think
think the Reserve Bank seems to feel that that amount is high. I mean, people have taken gold loans and then. So a couple of things are clear, I think. We are, at least for this round, more connected with the global market, and we are being influenced by that. We do, of course, have this strong counterbalancing effect of domestic flows. My question, of course, is now, will that offset? Will it not offset? And how are you seeing it? And within that, the way, let's say, in the last couple of days or in general, do you feel that there could be a divergence once again between, let's say, the more highly valued stocks that we've seen, or let's say the mid cap, small cap universe, and the large cap universe?
So typically the mid and small caps take it on their chin when the Nifty gets like a pimple also, right? So you get a problem in the mid and small caps, but that's the nature of the game. It is that, relatively speaking, the mid and small caps have a lot more of the investors that want to flee, get taken in by, WhatsApp doomsday conspiracies and stuff like that. Not saying they're always wrong, because someday there will be a doomsday, perhaps, and it may be useful in some circumstances to have exited early than later. But in general, I feel that the universe of the market universe is currently almost entirely affected. It's not like the large caps are down 1% and the mid caps are down 5. It's the large caps are down 2.8, the mid caps are down 3.5. It's not like there's a meaningful amount of difference. This is like, widespread across the board, kind of a little bit of a panic kind of a run. But when I say panic, I also don't mean of the kind that was 1987 when stocks fell 22%, or Japan where the stocks fell 13% today. It's a small kind of a run on it. I feel here, valuations wise, fundamentals wise, India is in a relatively good shape, even compared to Japan, where situations are different. Fundamentals compared to the US, where recession is oncoming. There is not that much leverage, other than what Abid mentioned, where people were borrowing money to do F&O, and also borrowing money from the banks, and then also getting subsequent leverage from the markets. Some of these excesses have existed for a long time. They come, people get wiped out, and then it kind of reaches a lull where then new players take time to build up the confidence to be able to do this. Usually speaking, we haven't seen massive drop in markets purely based on F&O based leverage. It will usually accompany a bunch of other things. It's like, if you put oil on a slide, it takes something to push you onto that slide, but the oil makes sure you slide faster, right? So your futures and options part is that oil, if you may. But I mean, at this point, I don't think the markets are in such bad shape that you should think that it's doomsday per se. I could be wrong. Who knows?
Got it. Okay. Last point, Abid, to you. So, how should people be looking at the derivatives market at this point? I mean, people, for everything that happens, I mean, there'll always be the counter, right? People say, oh, maybe this is a good time to get in because I was waiting for such a fall.
I don't think there is any good time to get into derivative market for anybody. I think people should stay away from it unless, see, the thing is this, right? If you ask me, can I beat Max Verstappen on a circuit around Spa? It is very obvious to me that I can't beat the guy. And yet, when you ask somebody on the streets in JP Nagar, dude, do you think you can outperform an FII who has $1 billion in research, who employed all the guys from IIT Delhi computer science toppers for their quant department, and who does not even code in Python, but he writes code in assembly level, and his server is sitting next to the NSE rack inside NSE building connected by a copper wire, where he is even measuring the microseconds between the data entry at his input port and exit port. Then this guy is like, yeah, I think I can beat that guy. What are you even smoking, right? So I don't think realistically, unless somebody is really, really dedicating 6 to 7 hours of his day in practice, introspection, trading, etc. in derivatives, I don't think if somebody thinks कि यार मेरे को लग रहा है market ऐसे जाएगा मैं half an hour in out करेगा, that's just flushing money down the FIA's toilet, right? So I don't think anybody should think of that. I think if there is something which everybody should do right now, that is they should seriously consider two things. One is build an Indian government bond portfolio. Indian GSEC yield was at 7.5%. I was doing so many stuff asking people, boys, please buy some GSEC 7.5%, 7.5%. Nobody listened to it. Everybody was partying in Nifty. There's something else which could have been done. I don't know if it's still a good trade. US government bonds were at 460 just 4 months back or 5 months back. Now they're at 380. Even otherwise, if you are fairly, well off, it's not a bad idea to consider parking some of your money inside a US government-backed asset. It purely, if not for return, just for diversification, right? So I think if there is something huge coming, people should think of two things: government bonds in local currency and in the reserve currency of the world. No derivatives, no nothing.
Deepak and Abid, thank you so much for joining me.
Thanks so much.
Anytime.
Indigo launches business class finally. So this is an announcement most frequent flyers and business travelers have been eagerly looking forward to, and I suspect a little more so ever since Vistara or Air India initiated a merger with each other. Budget airline Indigo has finally said it will introduce business class seats from mid-November on 12 domestic routes. So far, Indigo, as some of us know, or most of us know in here, has been a no-frills carrier with an all-economy cabin. Business Standard reported that Indigo will open business class bookings from August 6th for travel from 14th November, with fares starting around 18,000 rupees. It would also launch a blue chip loyalty program, and that will start around September. So the business class tickets will launch on 12 routes, starting with, not surprisingly, Delhi, Mumbai, but it will also serve Bangalore, Chennai, Kolkata, and Hyderabad within a year after the initial launch. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.